David, I also want to thank you for maintaining my confidentiality of my returns. That was helpful. Promise to do better for the rest of you. The overview I wanted to cover includes taking a look at markets and future returns. Obviously, there's been some reasonable volatility in markets recently. Take a look at where we can add value, not just in the real assets we're going to look at tonight, but in traditional asset classes as well. So look at private equity and how it works, and real estate and where it fits in. So about 10 days ago, I wrote a memo to clients after the market had corrected 10% called "The Sky is Falling," the Chicken Little scenario. And I should caution you, by the way, I have a tendency, because I'm mildly manic depressive, at least when I'm speaking in front of a group of people. So the first 10 minutes of this presentation will be depressing, and the last 10 minutes will be quite uplifting, so don't get too concerned in the next few slides, okay? So if we take a look at the TSX for the last, since 2000, the long-term rate of return has been a sort of okay 6% rate of return. But since March of 2009, the return has been 17% a year. In fact, basically, the entire return for the last 15 years has occurred effectively since March of 2009. If we take a look at the American stock market, there's an index called the Case-Shiller Index. It's really looking at the price-earnings ratio of the S&P 500 on a trailing 10-year basis. And the median return is around 16, 17. The current price-earnings ratio is 25. It's not an inexpensive marketplace for public equities. In Europe, as you can see from this magazine from The Economist, their view is it's a dead parrot. And for some of you old enough to remember Monty Python, we remember John Cleese. If he was redoing this skit today, he would say, "I want a refund, but not in euros." There are reasons for the European issues that have come about. The first is the unemployment rate is over 11%. It's under 7 in Canada. It's just over 6, or under 6 now in the US. 25 million unemployed. Interest rates have been falling for more than a decade, and now are so low that in Germany, France, and Switzerland, they can all borrow money for 10 years at less than 1%. The inflation rate in Europe has dropped from almost 3% to virtually 0, and the question is deflation next? So it's not exactly a growth engine. So what happens if we look for what major investors that seem to have a track record think? Well, here are 3 of them. This is Bill Gross, who used to be at PIMCO until he had a bit of a hissy fit with his existing management. There's Jeremy Grantham, well-respected person running a $100 billion group called GMO, and Carl Icahn, an investment billionaire. And all of them recently have said they're hedging their bets one way or another. So if we look at really what they've said, here's a headline from the Globe and Mail. Rob Carrick interviewed 11 investment advisors and came up with a consensus return that they had for the next 5 to 10 years on balanced portfolios. And what they said was, these 11 advisors expect balanced returns of roughly 5.5% a year. If you take away 2.5% inflation, it's going to be a net of 3% a year. And Bill Gross said, we've had our biblical 7 years of fat. Now, actually, it's more like 5.5, but we won't quibble about a couple of years. We must look forward to, by mathematical necessity, essentially a mean reversion of 7 leaner years, expecting maybe 3 to 4% in bonds, 5 to 6% in stocks at the outside. Jeremy Grantham more or less has said the same thing. No asset class that he looks at is priced to return more than a 5% real yield after inflation. And Warren Buffett, the master investor of all time, is expecting stocks to generate around 6 or 7%. So that's the environment they're coming from. Typically, of course, they're talking about developed countries' investments. So if we look to a different area, say emerging markets, we have to ask, is the picture any better? Well, the Conference Board said that China's growth rate is likely to slow sharply over the next 5 or 6 years. In fact, they think it will drop from the rate it is at today, slightly more than 7% a year, which is a great growth rate, to about 4% a year within 6 years' time. You have to remember, China was growing at 10 to 11% a year 5 years ago. back in around 2006, 2007, China and emerging countries were growing at 6% per year faster than the US. That essentially has slowed down, in some cases, to almost nothing. So when the economists first looked at this, they said in 2009, emerging economies should have caught up to the US in per capita GDP in 50 years. At today's growth rates, it's going to take 125 years. So they're not going to be the growth engine that we have experienced over the last 15 or 20 years in comparison to developed countries. If we look at bond rates, this is the consumer price index, the 10-year bond rate, and when I subtract the two together, I come up with the real rate of return on US bonds. All of them have been declining over the last 15 years. And if we just take a look at the real yield, the actual net return you make after inflation, the century started with 4% returns on 10-year government bonds after inflation. It's now less than 1, with the average rate for the last 15 years being only 1.4% a year. So all of this becomes extremely challenging because if you're trying to get a 4% real rate of return after inflation and costs, and 40 to 50% of your portfolio is only able to generate 1, then that's a lot of heavy lifting for the rest of the portfolio to generate. We're almost through the depressing part. Just give me a couple more minutes, okay? These are the bond rates. At the end of last year, we all thought that, bond rates had pretty well bottomed and rates would go up from there. Certainly expected it to occur by the end of this year or certainly early into next year, and that's not what happened. US bond rates dropped. This is from 2.7 to 2.3. They dropped in Canada. In Germany, they were basically cut in half. In Switzerland, it's less than 0.5% a year, the same as it is in Japan. And if you think about Switzerland and Japan in particular, the citizens of those countries are willing to give their government money for 10 years and take back 0.5% a year as a return, and believe that to be a good transaction. Not sure what they're smoking, but the question really about rates is we've been asking for years. When are they going to rise? Well, that's a very tough question to answer because of the other factors, deflation certainly being potentially one of them. Another place you can get a rate of return here is this. So if you want to speculate a little bit and you don't mind it being a little adventuresome, you can get a 7.4% return on 10-year government Greek bonds, and their Greek bonds are now have added up to a total debt of 175% of GDP. So if you don't like my big fat Greek debt, then you need to look at other alternatives.